Doing well. In today's video, we'll continue to use price action in order to take informed technical trading decisions on the market. The chart that I have in front of us is that of Nifty, and I have set it on the daily time frames. We will see this video in continuation with the previous videos that we have recorded on this. I have tried to create a separate watch list on Nifty itself, and hopefully I will add these videos consistently to that watch list. So we will see how our analysis pans out over a period of time. So we will immediately look back at the immediate price action, since we are analyzing this on the daily with the purpose of swing trading. And whenever we are analyzing a stock, like we have done so before, we will simply focus on the previous highs, which I have marked in this shaded rectangle, and the previous lows. And our objective becomes to connect them. Once we connect them, we note a pattern. The pattern is that the previous highs have repeatedly been lower, while the previous lows have repeatedly been higher. Now we know that an uptrend is higher highs and higher lows, whereas a downtrend is lower highs and lower lows. So this is neither an uptrend nor a downtrend, which means this security is creating inconsistent highs and lows, and therefore it is fairly obvious that this is a range. Whenever a security is in range, we have two options. Either we decide to trade a ranging security, or we simply choose to ignore it. If we decide to trade a ranging security, it is still my opinion that the direction of the trade should be in the direction of the longer time frames, and the videos in which we have discussed patterns on longer time frames are also uploaded. But if we are only using this time frame, like that is, if we are only using the daily time frame for trend assessment, which is what a swing trader will typically do, in that case, they are expected to trade as they see the chart, and what they will see in the chart is that the security is on the high of a range, and the low of the range is roughly 300 points. Now, when we know that a security is in a range, obviously we expect the security to remain in the range for as long as reasonably possible. This point of intersection between the lows and the highs typically gives us significant information on the breakout, of when the breakout is to be expected. Similarly, if the breakout does not happen within this point of intersection, the breakout will most likely fail, even if it does happen. So I will come to that. When we connect the lows and the highs, there is a point of intersection which basically gives us the length of this particular triangle. And typically, if you remember the Fibonacci series, you would remember that 38%, 62%, etc. are said to be strong Fibonacci levels. So if at almost 40% of the length of this point of intersection, if there is almost 40% time left, that is less than half the length, if in that the breakout happens, the breakout is usually very strong. If it extends to 2/3, that's nearly 70 or 62% or 65%, then the breakout is very weak and there is a possibility of failure. If it goes beyond it, then we should simply expect that this particular pattern is going to fail. So when a pattern forms, it also it gives us obviously the price, and it gives us a relation of time. So how do we put it into practice? We will see that this low was created in August 25, and that was obviously the start of the base of this pattern. Sorry about that. And the intersection happens somewhere in December 26, which means that this entire length is roughly of about 16 months. And obviously 40% of 16 months will roughly be 6 months. So which would mean that anything from August all the way till February, we have time up till February for a very strong breakout in the direction of the preceding trend, which is up. So if there is a breakout, that is this previous high, the high which is the second one that is marked here, if it is broken on or before February, then in that case we should expect a very, very strong upward rally in the market. If, however, this extends further and goes all the way up to, let's say, for example, July, then the breakout will be very weak in the market. But if it doesn't break out even till July, then in that case, we should simply not expect a breakout. So this would be how we would trade the pattern, and we would see that the duration is of several weeks or months, because this pattern is created on the daily. Whereas patterns which are created on the monthly or the weekly could last years. So keeping this in mind, Let us focus on the immediate price action. The immediate price action would be that the price is at the high of the range, and whenever a pattern is in, whenever we observe a pattern or whenever you observe a security in a range, we must understand that oscillators do a very, very good job. For example, let us just look here. If you see, I'll just mark this with a vertical line and this with a vertical line. You will note that this perfectly coincides with a highly oversold RSI. Similarly here, I can mark this as well as this, and this will also coincide with a perfectly oversold RSI. Same thing here, mark this as well as this, and we will again have a perfectly oversold RSI. Similarly, if we go for the highs, here we have the high, we'll just mark this, and here we will note that the RSI is highly overbought. Come back here and we will note the same thing here, that the RSI is highly overbought. And similarly here, when this was formed, the RSI became highly overbought. If you remember the previous video in which we discussed would we buy Nifty here, the answer is no. We will need for it to wait to become oversold. So here are the cases. Case number one is that the trader puts this security on a range and shorts the market because it is on the high of the range in highly overbought conditions, and obviously the stop loss will be the previous high. Personally, I'm not a big fan of that, simply because my biases are leading to me on the long side, which means that if I have no position, I would simply not trade anything right now. But if I am looking to trade in the direction of the longer time frame, what I will do is I will wait for this RSI to become overbought again, which means once the price comes here again, any point below where it is today, I would look at going long on it, and my premise would be range low, highly overbought. And also I would be trading in the direction of the structural trend of the market, which is on the long side. Now if I just zoom into the chart again and we notice this candle here, we will see that this has engulfed the previous candle. Okay, so if there is a red closing and a continuation on the red side, there will be a confirmation of the bearish engulfing, and so on and so forth. However, I would give higher weightage to this pattern than the engulfing. So what I would do is I would, rather than shorting the market here, because that is against my personal trade plan, but rather than shorting the market here, I would simply wait for it to come lower, become highly oversold, and then when it gives me a good green candle on that support zone, I would look at buying it. Given that this is the third test of the market, I would now begin to start getting very alert every time it reaches the high, because there is always this gut short probability of a short cover. So with that, I hope we have understood that in isolation, we want to apply RSIs or any other oscillators when we know that the market is ranging. In order to know that the market is ranging, we will simply look at what the previous highs and the lows are doing in relation to one another. If there is any inconsistency in those highs and lows, we are definitely going to assume that there is a range. Sometimes these ranges form patterns. If they form patterns, they give us frameworks on how to trade. Generally, you will always be able to trade on the long and the short side of both the patterns. My view has been that choose one side which is in the direction of the longer time frame. However, I would like to add that in my younger trading days, that is somewhere around 2015 to 1920, I would trade on both sides of the pattern, simply because I was just trading very few securities, maybe 5, 10, 15 securities. So I had all the time in the world to do this detailed assessment. So yeah, with that, I hope that we have learned something new. And to conclude, the most effective way to trade a pattern is to write the option. So which would mean that once we identify that the low of the pattern is 24,700 and the previous low is, let us say for example 24,600, it becomes logical that whenever we want to go long in this pattern, we are going to write the 24,600 put. Similarly, if a trader decides to go short based on this pattern, then you, since your previous high is 25,300, that is the call, or 25,400, that is the call that you're looking to write. And a trader who is only looking at this chart and does not does not look at the weekly, monthly or anything else, such a trader is going to write both the 25,400 call and the 24,600 put, putting the market in a 800 point range for the entire expiry. So there are different plays, all of them are correct in their own right, and the only thing that these plan of actions make sense for you will be the quantity that you take. while deploying either of these approaches to trading. There are many approaches which justifies why price changes so much in the market, and no right, no wrong. We just choose a style and we stick to it for as long as reasonably possible. So with that, I wish you the best, and I hope that we have a good trading week ahead.